Ladies and gentlemen, Asian guy here. We need to have a very serious conversation about what happened to your portfolio while you were sleeping last night. If you looked at your screen this morning, you saw a crime scene. You saw silver, which was trading near $83 just yesterday, suddenly free fall into a terrifying abyss, bottoming out at $73.72. That is a 14% drop in a matter of minutes. That is the kind of volatility that wipes out accounts, destroys confidence, and makes grown men panic, sell the bottom. I'm here to tell you that what you just witnessed was not a market correction. It was not a change in fundamentals. It was not retail traders taking profits or the bubble bursting. What unfolded before your eyes was a calculated mechanical execution, a surgical financial hit job executed in darkness, hidden beneath the year's thinnest liquidity conditions. If you dumped your silver holdings this morning out of fear, you didn't simply experience financial loss. You became a casualty of a precise algorithmic phenomenon called a value at risk shock, or VAR shock. To comprehend why silver plummeted 14% on December 29th, 2025, you need to shift your focus away from news headlines and direct it toward the timing. The collapse wasn't initiated at 9:30 a.m. when Wall Street's opening bell rang. It didn't occur during the London fix hours. The devastation struck at precisely 2 o'clock in the morning, Eastern Standard Time. Now consider this carefully. Who's actively trading silver at 2 a.m. during a holiday week? Not the retail trader from Ohio. He's sound asleep. Not the physical silver enthusiast in Germany. He's having his midday meal. Certainly not the pension fund administrator. He's vacationing in Aspen, hitting the slopes. The marketplace at 2 a.m. during what we call Ghost Week, that stretch between Christmas and New Year's, resembles an abandoned wasteland. Order books are skeletal. The bid stack, that protective wall of purchase orders normally catching declining prices, is virtually non-existent. The market is completely deserted. And that's precisely the environment where this catastrophe unfolded. Around 2 a.m., a massive institutional player, we're discussing a substantial hedge fund or prime brokerage account operating with extreme leverage, reached their breaking point. This wasn't a minor setback. They shattered through their maintenance margin threshold. In the world of institutional finance, breaching your maintenance margin doesn't result in a courteous phone conversation with your broker requesting additional capital. You face immediate liquidation, and the liquidation isn't handled by a human trader concerned with securing favorable pricing. A risk engine executes the liquidation. A risk engine operates as an emotionless, calculating algorithm with one singular directive: exit immediately. This algorithm shows zero concern whether silver trades at $83 or $73. Technical support levels are irrelevant to its programming. RSI indicators don't factor into its decision matrix. Its sole function is dumping the position until account solvency is restored. So at 2 a.m., this machine activated and began launching market orders into the silver marketplace. Under normal market conditions, with adequate liquidity, these sell orders would get absorbed, buyers would emerge, and the price might dip 50 cents or so. But during the graveyard hours of Ghost Week, zero buyers existed. The machine liquidated the initial 1,000 contracts, triggering a $1 price drop. It searched for additional buyers. None materialized. So it decreased the price another dollar to locate liquidity. The selling continued relentlessly, and prices kept tumbling. $80, $78, $76. It was desperately hunting for liquidity that simply wasn't available. This phenomenon is what we identify as a liquidity cascade. Picture a grand piano plummeting from a high-rise window. It doesn't halt until impacting concrete. The concrete, in this scenario, was $73.72. That's the price point where the algorithm finally discovered sufficient buyers to clear its order book. So when you observe that enormous red candle on your chart, don't interpret it as a trend reversal. Recognize it as someone getting financially annihilated in the market's basement. This was a forced liquidation episode, a margin call of monumental scale. And here's the most crucial detail. The detail mainstream financial media is completely overlooking. This selling was price agnostic. The seller didn't desire to offload at $73. They were compelled to liquidate at $73. That distinction is massive. If investors were divesting because they believed silver had become worthless, that would signal bearish sentiment. But when an algorithm is liquidating because a speculator went bankrupt, that's bullish for everyone else. It signifies the weak hand has been eliminated from the game. It means the leverage has been purged from the system. That whale's position overhang has vanished. They're out. They're finished. And now the market is cleaner, leaner, and positioned to rally higher. But the destruction didn't end with just that single whale. The initial dumping triggered a secondary detonation that functioned like accelerant on flames, because as prices began their free fall through $78 and $76, it awakened another monster lurking in the market. A monster residing within the computers of market makers and options dealers. We need to discuss gamma, More specifically, we need to examine the gamma flip that transformed a bad situation into complete disaster. Because when that whale started vomiting their position at 2 a.m., the banks positioned on the opposite side of these trades suddenly found themselves trapped in a mathematical hellscape. They held short puts and long gamma positions, and as prices crashed, their gamma flipped negative. I realize this sounds technical, but understanding this is essential to comprehending why the crash was so brutal. Negative gamma means that for every dollar the price declines, the bank is mathematically obligated to sell additional silver to hedge their portfolio. It creates a vicious doom loop. Price drops, bank sells to hedge. Price drops further, bank sells more. This explains why the drop accelerated from a correction into a full-blown crash within seconds. The dealers became forced sellers right alongside the liquidating whale. They were chasing prices down into the void, cannibalizing their own market because their risk management models demanded it. It was a robotic feedback loop of pure destruction. And all of this transpired while you slept. So when you examine that 14% loss, understand that it's artificial. It was manufactured by an absence of buyers and an abundance of forced robotic sellers. It bears no relationship to silver's fundamental value. It has nothing to do with solar panel manufacturers requiring silver. It has nothing to do with depleted mining reserves. This was a plumbing failure in the financial system. And just like any plumbing failure, when pipes burst, someone must intervene and repair them before the entire structure floods. And that's exactly what happened next. Because as the price struck $73.72, the system began trembling. The clearinghouses, the entities guaranteeing all these transactions, realized the imploding whale might not be capable of settling their obligations. If the whale defaults, the clearinghouse assumes the liability. And if the clearinghouse assumes the liability, the entire financial architecture faces existential risk. This is where the narrative shifts from a flash crash to a systemic rescue operation. Because right at the bottom, right when it appeared silver might collapse to zero, an enormous liquidity injection suddenly materialized out of nowhere. We're discussing billions of dollars. We're discussing a $34 billion emergency injection. You didn't encounter a press release announcing this. You didn't see Jay Powell delivering a speech about it. But if you examine the repo market data, if you analyze the overnight swap lines between central banks, you can observe the fingerprint. Someone intervened, someone plugged the breach. And that someone wasn't a retail trader buying the dip. It was the heavy hand of the system protecting itself from collapse. And this brings us to the mechanics of the rescue. Because this $34 billion figure is the key to understanding why the bottom is established. It reveals that the crash wasn't just allowed to happen, it was contained. They allowed the whale to die, but they saved the ocean. And now that we know the plumbing held, we can examine the aftermath. We can look at who remained standing. And more importantly, we can look at the one market that refused to crash. The one market that looked at this 14% drop and said, we don't care. Because while New York was burning at 2 a.m., Shanghai was doing something completely different. And the gap between the paper carnage in the West and the physical reality in the East has just expanded to a level that guarantees this game is far from over. Let's follow the money to where the real metal is. And that brings us to the number that nobody on CNBC wants to discuss today. The number is $34 billion. You witnessed the crash, you saw the 14% obliteration, but what you didn't see, what was concealed in the plumbing of the overnight banking system, was the massive sandbag that was deployed to prevent the levee from completely breaking. When a crash of this magnitude occurs, when a VAR shock sends an asset plunging 14% within minutes, it doesn't just damage the people holding the asset, it threatens the very survival of the clearinghouse. Consider the mechanics. For every long contract that the exploding whale possessed, there existed a short contract on the opposite side. When the whale imploded and couldn't satisfy their margin call, a black hole opened in the Chicago Mercantile Exchange's ledger. If that whale defaults, if they collapse to zero and can't pay what they owe, the clearinghouse itself becomes liable. And if the clearinghouse fails, the entire futures market, from crude oil to treasury bonds, freezes instantaneously. So at approximately 3:30 in the morning, right as the price was hammering against that $73 floor, alarm sounded at the Federal Reserve's overnight desk. They observed the stress in the repo market. They recognized that counterparty risk, the fear that your trading partner won't honor their obligations, was spiking to levels unseen since March 2020. The banks ceased lending to each other. Nobody wanted exposure to the toxic waste emerging from that liquidation, and that's when the fire hose activated. $34 billion of emergency liquidity was injected into the repo market. Now, I want to be crystal clear about what this signifies. The Fed didn't purchase silver. They didn't care if silver reached 0 or 1,000. They bought stability. They flooded the system with cash to ensure that solvent banks possessed sufficient liquidity to absorb the whale's carcass without collapsing themselves. They essentially lubricated the gears of the machine so it wouldn't seize up from the friction of the crash. This $34 billion is the invisible hand that caught the falling knife. It stabilized the bid stack. It gave market makers the confidence to step back in and resume quoting prices. Without this injection, we wouldn't be observing $75 right now. We'd be looking at market closures. We'd be looking at limit down halts and canceled trades. The fact that they had to intervene with that much capital reveals everything you need to know about how fragile the paper silver market truly is. It's a house of cards constructed on leverage. And today, the wind blew hard. The only reason it's still standing is because the central bank propped it up with a wall of freshly created money. But here's the irony, the sick, twisted irony of the entire situation. While the Western financial system was frantically printing $34 billion to patch a hole caused by a paper derivative explosion, the physical world was observing and laughing, because while the paper price was crashing, the real stuff, the actual metal, was doing something completely different. This brings us to the Shanghai reality check. If you want to know the truth about a crime, you don't interrogate the criminal, you consult the witness. And the witness to this crash is the Shanghai Futures Exchange. While New York was busy destroying wealth, China was busy pricing silver as if nothing happened. I'm examining the data from the Shanghai Close right now. The front-month silver contract closed at 20,073 yuan per kilogram. Let's perform the calculation again, because it's the most critical calculation of your life right now. 20,073 yuan divided by the exchange rate of roughly 7.04, divided by 32.15 ounces in a kilogram. $89.18. Do you see the disconnect? Do you see the insanity? In the West, the price is $75 because a hedge fund exploded and the Fed had to bail out the repo market. In the East, the price is $89 because they actually require the silver to manufacture solar panels and missiles. The spread, the gap between these two numbers, is now $14. This isn't a market inefficiency. This is a shattered market. A $14 spread on a commodity is unprecedented. It's economic madness. It means that for every ounce of silver you hold, the Chinese market values it nearly 20% higher than the American market. Why isn't the arbitrage closing? Why aren't traders purchasing at 75 and selling at 89? Because they can't. Because the January 1st export licenses have erected a wall around China. The metal in Shanghai is trapped, the metal in New York is frightened, and the two prices have completely divorced. This $14 premium is the ultimate proof that the crash was fraudulent. If there were a genuine glut of silver, if there were excessive supply, the price would be dropping in Shanghai too, but it isn't. It's holding firm near $90. That tells you that the drop in New York is purely synthetic. It's a paper event. It's a story told by algorithms to other algorithms. The physical market isn't participating in the crash. The physical market is saying, we'll gladly take all your silver at $75. Thank you very much. And this leads us to the most dangerous lie being broadcast on financial news networks right now. Turn on the TV and what do you hear? Retail panic. The mom and pop investors are fleeing. The silver bubble has burst. They're blaming you. They're attempting to convince you that this 14% drop was caused by thousands of small investors waking up at 2 in the morning and deciding to sell their coins. It's insulting. It's a fabrication. And the data proves it's a lie. We have the flow data from the ETFs. We have the volume data from coin dealers. Do you know what retail investors did while the price was crashing? They bought. The inflows into silver ETFs spiked this morning. Bullion dealers are reporting record website traffic. The little guy didn't panic. The little guy saw a sale and backed up the truck. The only entities that sold were the overleveraged institutional whales who got caught with their pants down. The smart money wasn't smart today. They were reckless, and they got liquidated. The dumb money, the retail stacker, was the one buying the dip. So don't let the narrative shake you out. This wasn't a vote of no confidence in silver. This was a margin call for the casino. The casino had to liquidate a player who couldn't pay his debts. But the chips, the silver itself, remained valuable. In fact, they're more valuable than ever because they're now in stronger hands. Every ounce that was sold by that bankrupt whale is now owned by someone who isn't leveraged, someone who won't be forced to sell at 2 a.m. The market structure has been cleansed, the weak hands are gone, the leverage is flushed. And what remains is a market that's primed to explode. So what happens next? We have a market that's been artificially smashed down to $75. We have a physical market in China trading at $89. We have a massive liquidity injection that has stabilized the banking plumbing. And we have exactly 3 days until the full institutional desks return from their holiday vacation. When those traders walk into their offices on January 2nd, what are they going to see? They're going to see a $14 discount. They're going to see a generational buy signal. In the next part, I'm going to walk you through exactly how the rebound plays out. We're going to look at the Jan 2nd gap. If you think the crash was fast, wait until you see the recovery. The slingshot has been pulled back to the breaking point. And on Thursday morning, someone is going to let go. Let's look at the forecast. And this brings us to the most terrifying part of the story. We've discussed the algorithmic execution at 2 in the morning. We've discussed the gamma flip that poured gasoline on the fire and turned a correction into a massacre. But we haven't answered the most important question. Why did it stop? Why did the crash halt at exactly $73.72? Why didn't it plummet to $60? Why didn't it reach $50? If the order book was truly empty, and if the negative gamma loop was forcing dealers to sell into a vacuum, the price should have reached zero. That's the mathematics of a liquidity cascade. When there are no buyers, the price finds zero, but it didn't. It hit an invisible brick wall at $73. And the reason it hit that wall isn't because retail traders woke up and bought the dip. It isn't because a mining company intervened. It's because the plumber arrived. We need to discuss the number that's hidden in the deep plumbing of the overnight financial system today. $34 billion. At approximately 3:15 in the morning Eastern Time, while the silver market was staring into the abyss, a massive injection of liquidity hit the repo market. Now, I know that sounds boring. I know that when I say repo market, your eyes glaze over. But you have to listen to me, because this is the smoking gun. This is the evidence that the system almost broke today. You see, when that institutional whale blew up at 2 a.m., when they breached their margin and the algorithms liquidated them, it created a massive hole in the balance sheet of the clearinghouse. The clearinghouse, specifically the CME group, is the entity that stands in the middle of every trade. They guarantee that if you win, you get paid, and if you lose, you pay up. But what happens when a player loses so much money so quickly that they can't pay? What happens when the counterparty dies? The clearinghouse is left holding the bag, and at 3 a.m. this morning, the clearinghouse was staring at a multi-billion-dollar hole caused by that whale's implosion. If they couldn't plug that hole immediately, if they couldn't find the cash to settle the trades, the clearinghouse would technically be in default. And if the clearinghouse defaults, the entire global futures market freezes. The game stops. The ATM machines stop working. It's financial Armageddon. So the red phone rang. Emergency protocols were activated, and the Federal Reserve, acting through its overnight swap lines and repo facilities, injected $34 billion of emergency liquidity into the banking system. This wasn't stimulus. They weren't distributing checks to people. They weren't attempting to lower interest rates. They were performing emergency surgery on a dying patient. They flooded the plumbing with cash to ensure that solvent banks had enough money to absorb the toxic waste from the dead whale without collapsing themselves. They effectively bought the bad debt. They plastered over the hole in the wall with a mountain of fresh cash. And that's why the price stopped at $73. The injection of $34 billion acted like a giant concrete floor. It gave the market makers, the big banks like Goldman and JP Morgan, the confidence to step back into the market. For an hour, they were too frightened to quote a price. They pulled their bids because they didn't know if the system would survive. But once they saw the Fed's money hit the wires, they knew the bailout was in. They knew the risk was capped, so they turned their buying algorithms back on. This is the dirty secret of today's crash. It wasn't a market event, it was a systemic event. The 14% drop wasn't discovering the fair price of silver. It was discovering the breaking point of the paper derivative market. And we found it. We found out that the paper market is so fragile, so overleveraged, and so hollow that a single bad trade in the middle of the night can threaten the entire structure. It took $34 billion of taxpayer-backed liquidity just to keep the silver market open for trading today. Think about the absurdity of that. We're talking about a metal, a rock, an element on the periodic table. It shouldn't need a bailout. It just is. But because the bankers have built a casino of paper bets on top of that rock, a casino that's hundreds of times larger than the actual amount of silver in the vault, the whole thing is unstable. They've rehypothecated the silver. They've leased it. They've leveraged it. And today, the leverage snapped. So when you look at that $73 low, don't see it as a technical support level. See it as the Fed put. See it as the line in the sand where the central bank said, no further. Because if it went lower than $73, the losses would have been too enormous to bail out. The $34 billion wouldn't have been enough. It would have needed $100 billion or $1 trillion. This injection is the ultimate proof that the game is rigged, but not in the way you think. It isn't rigged to suppress the price forever. It's rigged to prevent the price from causing a system failure. And today, the system failed. The only reason your broker app is even working right now is because of that $34 billion. But here's the catch. Here's the part that should make you extremely bullish. The Fed fixed the paper problem. They fixed the ledger, but they did not fix the physical problem. They printed $34 billion, but they did not print a single ounce of silver. They patched the computer code, but they didn't fill the vaults. And while they were busy playing plumber in New York, trying to stop the leak with paper money, the rest of the world was watching. Specifically, China was watching. Do you think the Chinese government cares about the CME clearinghouse? Do you think the industrial buyers in Shanghai care about the repo market spread? No. They saw the crash. They saw the weakness. And they saw the desperation of the Western central banks. And their reaction wasn't to sell. Their reaction wasn't to panic. Their reaction was to do something that completely exposes the fraud of the paper price, while the Fed was spending $34 billion to save the paper market. At $75, the Chinese market was trading in a completely different reality, a reality where silver isn't a liability to be managed, but a strategic asset to be hoarded. And the price they're paying right now, the price that held firm while New York collapsed, proves that the West is an island of delusion. In the next part, we're going to leave the broken plumbing of Wall Street and travel to Shanghai. We're going to examine the real price. We're going to look at the data coming out of the Shanghai Futures Exchange that makes a mockery of the $75 spot price. Because while the Fed was plugging the hole, China was widening the gap. And the spread between the two worlds has just blown out to a historical extreme. I'm looking at the closing data from the Shanghai session right now. The front month silver contract closed at 20,073 yuan per kilogram. Let's translate that into the language of Wall Street so there's no confusion. We take 20,073 yuan, we divide it by the exchange rate of roughly 7.05 yuan to the dollar, and we divide that by 32.15 troy ounces in a kilogram. The result is $89. Do you understand what that means? It means that right now, as we speak, there's a $14 spread between the price in the West and the price in the East. $14. That's roughly an 18% premium. In a functioning market, that's impossible. It's a violation of the laws of economics. Arbitrage traders should be buying every single ounce in New York at $75 and selling it in Shanghai for $89. They should be closing that gap in milliseconds, but they aren't. The gap is sitting there wide open, screaming at us. Why? Because the market is broken. Because the January 1st export licenses have created a firewall around China. The traders know that they can't move metal freely anymore. The physical flow has stopped. So we now have two markets on planet Earth. We have the paper market in New York, which is driven by algorithms, leverage, and bailouts. And we have the physical market in China, which is driven by industrial necessity and fear of shortage. The paper market says silver is worth $75. The physical market says silver is worth $89. And if you want proof, absolute undeniable proof that the physical market is calling the bluff of the paper market, you just have to look at what happened at the COMEX vaults on Friday. While the price was starting its descent, while the Ghost Week trap was being set, the smart money was backing the truck up to the loading dock. We just got the inventory report. It's hot off the press. 600,133 ounces of silver were physically withdrawn from the Loomis vaults on Friday. Gone. Removed from the system. Total COMEX inventories have now dropped to 449,127,595 ounces. Think about the timing of that withdrawal. 600,000 ounces left the vault before the crash. Whoever took that metal didn't care about the chart. They didn't care about the RSI. They didn't care about the Ghost Week volatility. They saw the price, they saw the shortage, and they took the physical metal into their own possession. They drained the vault. This is the behavior of a buyer who knows that the price is fake. They're using the paper suppression to drain the physical supply at a discount. It's the ultimate bank run. They're trading their paper fiat currency, which the Fed just printed 34 billion more of, for the hardest asset on the planet. This withdrawal explains why the Shanghai premium is real. The metal is moving from the weak hands of the West to the strong hands of the East, or to entities positioning for the East. The West is becoming an empty shell, a showroom with no inventory. The price tag says $75, but when you go to the shelf to buy the product, the shelf is empty. That 600,000 ounce withdrawal is the sound of the shelf being cleared. So when you see the crash on your screen, you have to ask yourself, which signal do you trust? Do you trust the red candle created by a bankrupt hedge fund and a robotic algorithm at 2 a.m? Or do you trust the 600,000 ounces leaving the vault? Do you trust the panic of the paper trader? Or do you trust the $14 premium of the Shanghai industrialist? The data is screaming at you. The crash is a lie. It's a smokescreen designed to hide the fact that the physical inventory is dangerously low. If silver was truly abundant, inventories would be rising. People would be dumping metal back into the vaults. But they're taking it out. They're running for the exits with the physical bars in their hands. This disconnect, this massive chasm between the paper price and the physical reality, cannot last forever. Eventually, the paper market breaks. Eventually, COMEX has to admit that it doesn't have the metal to back up the contracts. And when that happens, the price won't just rise to $89 to match Shanghai. It will blast past it. It will reach $100 in a heartbeat because the realization of default will cause a panic that makes today's crash look like a picnic. But the media isn't telling you this. They aren't telling you about the Loomis vault withdrawal. They aren't telling you about the $14 spread. Instead, they're spinning a narrative designed to make you sell. They're blaming you. They're calling it retail panic. They're trying to gaslight you into believing that the reason that silver crashed is because small investors got scared. In the next part, I'm going to dismantle that lie piece by piece. I'm going to show you the flow data that proves retail investors didn't sell a single ounce. I'm going to show you who really sold and who really bought. Don't let them blame you for their crime. Let's look at the retail panic narrative and expose it for the fraud that it is. The headline on Bloomberg reads, "Silver plunges as retail investors panic sell." The headline on Reuters says, "Profit-taking by small investors caps silver rally." They're painting a picture of thousands of mom-and-pop investors waking up at 2 in the morning, collectively deciding that silver is a bad investment and frantically hitting the sell button all at the same time. I'm here to tell you that this is a lie. It's a mathematical impossibility, and I have the data to prove it. We have access to the flow data. We can see exactly what the retail investors did today versus what the institutional algorithms did, and the data shows the exact opposite of the media narrative. While the price was crashing to $73, the inflows into the major silver ETFs, SLV and PSLV, actually spiked. Retail investors didn't sell, they bought the dip. The volume at the major online bullion dealers, APMEX, JM Bullion, SD Bullion, is currently 3 times higher than a normal Monday, and 90% of that volume is on the buy side. The little guy saw the price drop and said, "Thank you for the discount." So if retail didn't sell, who did? Who dumped 5,000 contracts in a single second at 2:15 a.m.? It was the whale. It was the forced liquidation of the over-leveraged institutional player we talked about in part 1. The selling came from a distressed entity that had no choice. It came from a robot executing a bankruptcy order. It did not come from the community of silver stackers who have been holding for 5 years waiting for this moment. So why is the media lying? Why are they pushing the retail panic narrative so hard? Because they need a scapegoat. They cannot admit that a major financial institution blew up. They cannot admit that the clearinghouse almost failed and needed a $34 billion injection. If they told the truth, that the system is fragile and broke down because of one bad bet, it would cause a real panic. It would cause a run on the banks. So instead, they blame the volatility on unsophisticated retail traders. They gaslight you. They want you to believe that you're the weak hand, so that you will doubt yourself and actually become the weak hand. It's a psychological operation. They're trying to shake you out of your position because they need your silver. Remember the 600,000 ounces that left the Loomis vault? Remember the $14 premium in Shanghai? The smart money is desperate to get their hands on physical metal before January 2nd. And the only way they can get volume is if they convince you to sell yours. They're fishing for your shares. They smashed the price to scare you, and now they're using the media to shame you. But the data doesn't lie. The retail investor is the smart money today. You're the one buying the asset that China is paying $89 for while the pros are being liquidated. You're the one holding the lifeboat while the Titanic hits the iceberg. And this leads us to the final piece of the puzzle. If the selling is finished, if the whale is dead and the retail investor is holding strong, what happens when the market opens on Thursday? We have a market structure that's now clean. The leverage is gone. The forced sellers are out. The only people left in the market are the believers and the physical buyers. And on January 2nd, the institutional desks return with a mandate to allocate billions of dollars into commodities. This sets the stage for the Jan 2nd gap. We're not looking at a slow recovery. We're looking at a slingshot. In the final part of this report, I'm going to give you the specific forecast for the next 48 hours. I'm going to tell you exactly how the price will move when the vacuum of Ghost Week is filled by the tsunami of institutional capital. The crash is over. The trap has failed. Now comes the chase. Let's look at the targets.